Hello, this is Investing Sense, and thank you for joining us today. My name is Jack Szulinski. I'm a financial advisor with Edward Jones here in Wayne. And what we like to do here on Investing Sense is help educate our local community on certain financial topics. Our financial topic today is going to be taxes, which is a very important topic at this point in time of the year. With me today, I have a local CPA, Mr. George Shoffner. George, thank you for joining me today.
Thanks
I appreciate
for having me,
your
Jake.
time.
Thank you.
I know it is a busy time for you, so any time out of the office around this time is very valuable, I know. But again, thank you, and we are going to talk about taxes, a few different topics pertaining to taxes today. But first and foremost, tell us a little bit about yourself. How did you get into becoming a CPA, and where did you start?
Well, when I was in high school, I really had a fascination with math and science. So I went to college thinking I was going to become an engineer. And after my first year in college, I found out that engineering and I didn't really quite get along. Unfortunately, I went to Lehigh University, which had a very good business school. Right. So I transferred into the business school and looked around. They had a very good accounting program. I got involved in accounting, and the rest is history.
There you go. Well, perfect.
Yeah.
So you have your local practice right here in the King of Prussia area.
Correct.
Who do you mostly work with? Individuals, families, businesses? What's your...
Most of our work is with individuals and small businesses.
Okay.
We do mostly small family-held businesses and a lot of individual tax work.
Okay. That's good. I mean, with the amount of small businesses we have in this area and the amount of people, we just keep growing and growing. I'm sure it keeps you busy. Well, there's three main things that I'd like to talk to you about today along the line of taxes. The first thing being fraud, which is, of course, an extremely important topic because we feel like in this day and age, the increasing number of cases with fraud are astounding, especially when it comes to taxes.
Exactly.
Second, the general tax prep, what people should be kind of looking out for, how they prepare, how they can work with a CPA. And then the last thing, there's this new act, the Secure Act, that's come out that I know is going to affect a lot of people. So I want to touch on that as well. But first, we'll start with the fraud and how, again, astounding the numbers are that I've seen about how frequent it happens. So what types of common fraud do you see when it comes to tax preparation?
Well, the biggest one these days are people that are falling for the phone call from the IRS that tells they get a phone call that this is the IRS, we're coming to arrest you, you've got back taxes, you have to go to a store, buy a gift card and send it to us immediately.
Right.
The IRS will never contact you by phone, never contact you by email. So anytime you get anything like that from the IRS or Social Security Administration, you know that it's probably somehow tied into fraud.
Right.
But I've got a lot of clients that have called me and said, I just got a phone call from the IRS. You handle my taxes. I told them that I have an account that handles everything, and they told me they're on their way to arrest him as well. So, that's the biggest one. And I've read cases where people have actually lost thousands and thousands of dollars doing that.
So that's the big red flag first, is
correct.
when they communicate, whether it be through a phone message or an email. Right. So that's not going to happen.
The IRS will never contact you with phone or email unless you've already got an audit going, and you'd be contacted by mail first to inform you that there is an audit underway and everything else.
So if there is anything official that's going to happen, it's got to come by mail first. So that's the first thing to look out for. And then I would assume as well, just as a follow-up to that, if you do receive a phone call or an email or a piece of mail, the first person you should probably go to is your accountant and say, hey, this is what I got.
Exactly. Is this legit? Is there a possibility that I could possibly owe this?
Sure.
Another thing is there's a lot of phishing schemes out there. So they'll contact you again by email and ask you for there's a mix-up with your Social Security number on the tax return. Can you please provide your Social Security numbers? Again, the IRS will never contact you by email, but if you get something like that, you can forward it on to the IRS. They have a website, phishing, PHISHING @irs.gov.
Okay.
So you can forward it on to the IRS. They supposedly look into that and try to follow up on that. Yeah. But that's something to follow up on.
Yeah, absolutely. I mean, hopefully they can investigate and get to the bottom of it. But I know a lot of these scams as well, develop not within our borders either.
Right,
They're from overseas.
Correct.
And, sometimes they have a hard time tracking things down. But again, I mean, if you can see some of those red flags, I would assume that's the best way to start, is to dig a little deeper with your CPA to figure out, hey, is this legitimate or not? What else can we kind of do to prevent any of this from happening besides the immediate red flags and saying, okay, well, I got a phone call, I got an email?
Well, the other things you have to look at for, there's a lot of, believe it or not, unscrupulous tax preparers out there that'll guarantee you a refund or tell you that, oh, listen, we can make your refund larger. Let me try to do this. Let me do that. And next thing you know, you'll get a tax. There was several years ago, there was a preparer in the vicinity that was helping people. And when one of the persons got an audit, they said, I want to talk about the windmill in your backyard. He goes, I don't have a windmill in my backyard. Well, according to your tax return, you do. You know?
Oh my goodness.
So you have to be careful. Anytime a tax preparer is guaranteeing you they can get you money back or something like that, there's usually something behind that.
Yeah.
You also have to make sure that you don't get involved in a scheme where the tax preparer is going to take part of your refund and have it deposited into his account. We're not allowed to do that. I mean, so that's
Yeah, absolutely. So let's talk about that when we actually file the returns. And I know from working with you with clients over the years that you can file electronically, of course, nowadays.
Right.
I think a lot of people have questions about that. Is that safe? Is that going to be an issue, or is that already an issue?
I think the electronic filing is very secure through the IRS. Okay. In fact, we're mandated that if we prepare so many returns, we have to file electronically. Okay. So it's not a choice unless the client wants to opt out of it. So I still have some clients that say, I don't feel comfortable filing electronically. I'd rather file by paper. It slows down your refund if you have a refund, but again, they don't. But these days with the mail, sometimes I think you're more secure filing electronically. We get confirmation immediately that the return has been accepted, and so we know that it's gotten there. Right. And it's usually very secure that way.
Great. Now, I think the biggest, issue that I've seen with fraud from, how much of a pain it is if somebody actually files taxes in your name or under your Social Security number. What does that look like if that happens to somebody? What steps should they take, first?
The first thing they should do is contact the IRS. If you file electronically and somehow the return gets filed and it bounces back and it says that there's been a return filed under that Social Security number already. Mm-hmm. Obviously, you want to verify you've got the correct Social Security number on the return and everything, and then you have to contact the IRS. They will go through several steps. They'll issue you a number other than a Social Security number to use that lets them know that you've been subject to fraud. Gotcha. And it's very complicated, very time-consuming, but it happens, unfortunately.
I've seen it happen with multiple clients before, and I know it's a process that is not easily unraveled.
No, it's not. It's not.
Okay, well, let's move on to a couple other things other than the fraud aspect. So the general tax prep, I think the biggest question that I get from clients, of course, is the difference between using a CPA or a software program like a TurboTax or something like that. Is it right for a certain person to use a CPA or a TurboTax? Is it, certain, situations in their taxes that would depend on each one, or is it just personal preference?
Well, I think a lot of it's personal preference. A lot of it depends on how much time you want to spend. I think TurboTax and programs similar to that do a very nice job. If you have a fairly basic return, it's great to go through TurboTax. It asks you the questions, you can fill in the answers, and you've got your return. I find a lot of our clients have more complicated returns. They're involved with rental properties or some investments, a lot of buys and sells of stocks and things. So they get involved in it more than just a traditional, here's my mortgage interest, here's my real estate taxes, my contributions. Yeah. So, but I mean, again, TurboTax does a great job. A lot of times when you're working with a professional, he can help you uncover some deductions that you may have missed in the past.
Right. That was one of the things I always thought about as well, is that TurboTax, if you go through it, it's great. Like you said, you could probably get the end result if you have a simple enough return. But it only asks certain questions. It may not ask that follow-up question that a human may ask.
And we've uncovered a lot of deductions that way. Talking to someone, they mentioned something. It's like, well, you didn't tell me you did that. Well, I didn't know it meant anything.
Right.
So
if they're just answering a yes or no question on a program, we're never going to uncover that either. So that makes sense. How does a person know if they are going to go through it on their own, the different types of deductions? Or if at that point they have those kind of questions, is it better to consult a CPA?
Right. I think that's, what I do a lot of times with my clients, we have face-to-face interviews, at least in the beginning, and we'll sit down and go through everything. I'll have them bring in any tax documents they have. We'll review them, and I'll ask questions. They'll ask me questions. Again, that might involve a follow-up visit to bring something else back in. But that's how we can find the deduction. I mean, most people are aware of the regular deductions, the mortgage interest, the real estate taxes, the donations. But again, a lot of times through working with somebody, you'll find that there's something else involved in the return. They have a rental property. They have a property. I have this property. I'm getting some money for it, or so.
How does that affect me?
Exactly. Yeah.
What is usually the biggest question around tax time that you get from just individuals and families? What, when they come in, and is there usually one question that's
how much is this going to cost?
There you go.
The biggest one.
Yeah.
No, a lot of them is what can you do for me? It's what does this involve? Now they've simplified the tax code supposedly. Right. Do I really have to go through and itemize my deductions? Is it worth it for me to go through and add up my medical expenses? And we have to take a look at that and see if it is.
Right.
And whether the standard deduction will still be higher than the itemized deductions.
Right. Now let's talk about that. So cost, what that looks like. So now, do most CPAs, including yourself, do something like an hourly? So you figure out how much time that you have to put into it. Is it based on the specific complexity of what you're doing? How does that work?
A lot of it's based on, I think, the complexity. Some accountants still charge by the hour. With the tax programs that we're using now, some tax programs are fairly expensive. Right. We use a fee schedule based on the forms that are in the return and the amount of time it would take to prepare that form. Right. And then we'll sometimes come up with a fee and subtract from that, write it down a little bit. But that's how our firm does it.
That makes sense. So you talked about buying and selling of stocks and investments and things like that, and that's one of the big questions that I get from a lot of my clients. Of course, at the end of the year, at the beginning of the next year, when the tax forms start rolling in, we get a lot of questions around cost basis and things like that. So a lot of my clients have either been gifted stock or have bought stock many, many years ago, and they're missing cost basis. They don't know what they paid for it, and then they maybe do want to sell it or maybe want to gift it to somebody else. How much do you run into that?
I run into that quite a bit, and unfortunately, most people think that if they've been gifted the stock, and somebody gives you 100 shares of Apple today, then your value of that stock is whatever the stock was selling for today. And with a gift, the value that you get, the basis in that stock is the same basis as the giftor had. So you have to find out when they originally purchased it and what that cost was. Yeah. An inheritance, on the other hand, it's the date of death. So if someone dies and leaves you 100 shares of Apple, it's easy to go back at that date of death and say, this is what it was selling for that day. Correct. Right. If you don't have that, it's a little bit easier these days than it was back in the old days when I first started. We had to go to the library and they got all Wall Street Journals and things. But I think the best thing to do is try your best to determine when the person owned that stock originally, when they first purchased it, and go back and look it up and go through the internet. You can do some research, find out how many splits, and just come up with some type of a good backup for the cost basis that you've arrived at. I mean, obviously, you should ask for the basis if anybody has it. If you keep good records, you'll probably have the cost basis.
Absolutely. But in some cases, there's just no way of getting that cost basis. Even if it was gifted at some point and then that person did subsequently pass away at some point in time, that
I have a lot of clients that were back in the old, in the AT&T days and the stock purchase plans and everything. It was like, what should I do? I said, just hold it till you die. It's going to be a lot easier for your heirs than it is,
Absolutely. So we talked about inheritance. So the cost basis of something. So like you said, if somebody passes away and leaves you 100 shares of Apple stock, your cost basis is the value of the stock that day that they pass away. Does that matter if it's parent, grandparent?
Doesn't matter.
Doesn't matter.
Doesn't matter.
So that makes it a lot cleaner if somebody's inheriting something.
Correct.
You can start fresh from that way. What about if you're gifting stocks or other investments to charities or something like that? How does that work?
In that case, you get a deduction based on the value of the date of the gift. So if you have Apple at $1 a share and it's selling for $300 a share, and you donate that to a university or a church, you get the value of the write-off that you get is the $300 a share at the date you gave the gift. So it's a good way to get rid of appreciated assets. And if your plan was, I'm going to sell my Apple stock that I have for $300 a share, I'll sell 3 shares and give $900 to my church. Well, now you've got a $900 or capital gain if you paid $1 a share for it. You're better off just giving the 3 shares to the church, getting the $900 write-off instead of paying the capital gain first. So.
And then, correct me if I'm wrong here, the church in turn, if they go and sell the position, they're going to be in a lot better tax position.
Well, they're tax-free, so they don't have a tax. Yeah, exactly.
That's going to clean it up a lot easier. How about when we talk about the RMDs from a retirement account, so the required minimum distributions, and gifting those directly to a charity, because that comes up a lot
That's
with
a
my
very
clients
good
as
point,
well.
and that's what we're doing a lot with our clients. So a lot of our clients that are taking RMDs are, well, now 70.5, but I assume we'll talk about the change in the law. But
Yes.
at 70.5, they've paid off their mortgages. They don't have a lot of big deductions, so they're getting a real high standard deduction under the new tax law. So they can no longer itemize, or itemized deductions aren't as high as their standard deduction.
Sure.
But they have a church they want to give $5,000 to, or a university they want to give $5,000 or $10,000 to. If they do that out of their RMD, so directly from the RMD, and the money goes to charity, that reduces their RMD. That reduces their taxable distribution from the IRA.
Gotcha.
They still get the full standard deduction, and the church is getting their $10,000. The university is getting their $10,000. In addition, that helps to keep their adjusted gross income lower for Medicare purposes when they can come up and get a bump up in the amount of Medicare that comes out of their Social Security. Right. So we're recommending a lot of our clients talk to their financial advisors about making their charitable contributions out of their RMDs, especially if they don't need that RMD.
Yeah, that makes total sense. How about from an income standpoint? So we talked about your gross income, your adjusted gross income. Is there a magic number that you can try to be at that's going to make everything a lot simpler? So I know there's some different levels when it comes to taxation of Social Security and other things, but when you're getting at that level, is there a specific magic number that you're looking at?
Well, yeah, they are, and obviously it varies for whether you're single or married filing jointly. So there's things you have to try to do to stay under that number, or you'll get the extra bump in your you'll get a letter from Social Security saying we're now going to take an extra $90 a month out of your Social Security pay or whatever. So that's where the qualified charitable distributions from the RMD make sense.
Right. Yeah, and that's a lot of questions that I get from my clients as well that are getting to that Social Security age. So they're getting into their 60s, deciding when they're actually going to take Social Security, and they say, wait, I didn't realize Social Security was actually taxable. Right. And it is taxable at certain levels.
Up to 85% of it can be taxable, correct. Okay. And it starts at certain levels, again, differing for single and married, but up to 85%. You can go from 0 taxable, from 50% taxable, up to 85% of your Social Security taxable. Right. And once you get into that situation where not all 85% is taxable yet, if you're sitting there saying, okay, 60% of my Social Security is taxable, and all of a sudden you get an extra $1,000 in income, that might make 80% of your Social Security taxable. So instead of just paying tax on $1,000, you might be paying tax on another $3,000.
So you gotta look at that.
You gotta really be careful with that. Right.
Absolutely. So we talked about some of the required minimum distributions going directly to churches or institutions and getting that out. That will lower our income. Right. What other things that stand out to you that we can do to lower our income? So if we're trying to drive that number down to pay a little less tax, what are some of the simple things that we can do?
Well, obviously, if you're working, maxing out on your 401k, looking at IRAs are always big things. Working with your tax advisor, with your investment mix. A lot of times you'll see that when you're doing tax investing, if you've got big gains and you've got some losers in your portfolio, they'll balance out the gains with the losers in the portfolio, so you're not getting it with the large cap. Yeah. So a lot of it's just really taking advantage of to lower the adjusted gross income on the front page of return, taking advantage of some of the tax deferred things that you can do, and then timing some of your income as well.
Yeah, no, that makes sense. So the last thing I want to talk to you about today was the Secure Act. Now, the Secure Act actually stands for the SECURE, Setting Up Every Community for Retirement Enhancement Act. So I want to ask you about a few of those changes because I'm sure it affects a lot of people that you're currently working with. You alluded to one earlier. So the RMD age has changed. Right. So talk a little bit about that.
So Congress, in their great wisdom, passed this act around the end of December, which is a lot of the stuff is retroactive to not only beginning of 2019, but also back to 2018. Okay. They've changed the age of the required minimum distribution starting in 2020. So if you're already taking a required minimum distribution and you're not 72 yet, you have to continue taking it. But
so the new age is 72.
72 beginning in 2020.
But
correct.
If you're already collecting, so you turned 70 and a half last year, the year before, you're stuck.
Yep,
you're in
exactly.
it.
You're in it. You're doing it.
Okay.
They've also changed the fact that as long as you're continuing to work, prior to this act, Once you reach 70 and a half, you can no longer contribute to an IRA.
Okay.
If you were working, you could still contribute to a 401k, but you can contribute to an IRA.
Gotcha.
Now, as long as you're working and you have earned income, you can contribute to your IRA.
Okay.
Over age 70 and a half.
So that will, in effect, as well, lower some people's income.
Correct.
So if you're still
Absolutely.
working over the age of 70 and a half and you want to contribute to a traditional IRA, you're welcome to do it.
Or a Roth, right.
Or Roth, yeah.
Depending which way.
Right.
They've changed if you inherit an IRA. So when my mother passed away, she had an IRA that got split between my sister and I. I took my half of the IRA, and I was required to continue to take distributions out. I could always close the IRA, but I could take distributions out based on my life expectancy.
Right.
So but under the new law, you only have 10 years to take out the money.
Yeah. So
unless you're the spouse can roll it over, and there's certain other requirements. If you're within 10 years of the person that received it, that you inherited it from, you can continue to do it. But
okay.
Yeah.
Yeah. So the old rule used to be called the stretch IRA because, like you said, you stretch it out over your lifetime.
Correct.
So let's take an extreme example. So you're somebody passes away, you're a family member, and you inherit a $5 million IRA.
Right.
So under the old rule, that $5 million is going to be taxable as you take it out.
As you take it out, stretched out over your life
Exactly,
expectancy.
but you get to stretch it out. So if you're in your 40s, your 50s, your 60s, and you live a pretty good life, you've got a long time to stretch that out. So under the new rule, you're saying that's all been compressed
10 years.
to 10 years if you're a non-spouse.
Right.
So that's a huge issue.
Absolutely.
So now, in that same scenario, if I just inherited $5 million from a family member in a retirement account, and I have 10 years to take it out, the tax on that is going to be pretty substantial.
Absolutely.
Even if you spread it out over 10 years.
Right.
So that's going to affect a lot of people. Now, again, I know I'm taking an extreme example at $5 million, but even a couple $100,000.
Yeah, exactly. I mean, and when you're that age, you're still working. You're probably making a fairly decent salary, and all of a sudden you're throwing that on top of it.
Right. Yeah. So if you're in your 40s, your 50s, and you're working full time, possibly at the height of your career, you're adding more income on top.
Exactly.
So that could be something that you have to look at.
Right.
I mean, again, any mitigation to that you could take a look at?
I mean, again, that's something you work with your tax advisor or your financial planner and see what you can do.
Yeah, absolutely. So a couple other things under the new Secure Act that I thought were pretty pertinent. The one thing being about 529, so college education plans that you can put money away for.
Big change, right?
Yeah.
So 529 plans could be used to pay for college. Right. So you put the money in a 529 plan. For federal purposes, there was no deduction for it, but the money grew tax-free.
Right.
And when you took the money out, it was tax-free if it was used for education.
Right.
What we found was that a lot of the plans were started when children were young, very young, and had grown to be pretty substantial. And suddenly a child goes to another school or whatever, and there's money left over after they get out of school, or they incur student loan debt. Now you can take up to $10,000 out and apply it against the student loan debt.
Wow. Okay.
So that's nice.
Yeah, absolutely. That's a huge
In addition, you can use it for apprenticeship programs, which is something new. It had only been used for colleges in the beginning.
Right.
Now it can be used for private schools and education, or primary schools, and now it can also be used for apprenticeship programs.
So that opens it up a little bit more, and especially with our student loan crisis that we have right now, which is always a hot topic, in Washington, and who knows where we're going to be with that in the years to come. But to have that, to be able to use up to $10,000 for student loans.
That's huge, right? Because I've seen a lot of clients in the beginning, they'll sit there and say, well, I paid for the first year by myself, or we got a loan for the first year because we got a great rate, but now, and then the student graduates or doesn't graduate, and suddenly you've got this money left in the 529 plan. Yeah. Prior to this time, you'd had to try to find another beneficiary for it, shift it to another grandchild or something, whereas now you can use it to pay down some of that student loan debt, which is great. Yeah,
that's a huge help. Right. One of the last things I thought was important under that was you said you worked with small businesses. So there's an increase in a tax credit that small businesses get if they set up a retirement plan.
They can get up to a $5,000 tax credit for setting up a small retirement plan. A SEP plan, a simple plan, or a small 401k plan, which is really nice. It's a nice benefit. It's based on the cost of setting up the plan, which is very helpful. The idea is they're trying to get more people to save for retirement.
Sure. So it's a good benefit for the employees as well as now for the employer to kind of give that little bump for the tax credit.
Absolutely. And in addition to this, now some of the things that were started were they've restored the energy credit for insulation and storm windows and storm doors in your house.
Right.
Last year you weren't able to take it, but if you put in a storm door, storm window, now you can go back and amend last year's return, the 2018 return, and take that deduction. And there's some other little things in the plan that made it just enough to give accountants gray hair.
Absolutely. Well, after going over all of this, it seems to be that that a person should really talk to their financial planner, to their CPA, and kind of get a grasp of what's going on, because there's so many nuances in all of these tax changes and in every individual's plan that, at least sit down with somebody and say, hey, is it worth it? Back to your point, what can you do for me? What can I actually help out with?
We have a lot of clients that we work with their financial planners, which is really nice. Beginning, starting around November, we'll get a phone call from the financial planner, and they'll say, does my client, your client, have any net operating loss carry forwards? We're trying to do some year-end tax shuffling of investments and stuff. And I think a lot of times when you work as a team, you're really able to help benefit the client.
I absolutely agree. Well, again, I want to thank you today. I know this is a hectic time for you, a very busy time, so we appreciate you taking your time to be here with us. This, again, is Investing Sense. Thank you for tuning in today, and we look forward to seeing you next time.